So, viewers and listeners of Dollars and Making Sense, we wanted to focus on education. A big element of investors investing poorly is not knowing. And so today, Henry, I want to talk to you about passive versus active investing. It's something that gets talked about a lot. And again, some people have come to me and said, what does that actually mean? So in the first instance, I picked up a very good article during the course of this past week, just as we're wrapping up 2019. And the grab line was, passive strategies are growing in popularity. I think that's fair to say, isn't it?
It's massively fair to say. Passive investing, if you like, has been a huge winner since the GFC, a huge winner, both internationally and in Australia.
So very, very simply, can you explain to the viewers and listeners what it means? What's the difference between active investing and passive investing?
Well, active investing is where a fund or an individual, I guess, makes active choices, buys and sells, and it does stock picking and does research and looks at the underlying assets, looks at the fundamentals, looks at the technical analysis, and makes decisions based on that, and then assembles a portfolio or a grab bag of stocks or whatever, and actively manages those as a portfolio.
That sounds incredibly impressive. I mean,
it is.
That sounds like somebody that knows what the heck they're doing.
It is, and it does sound all great. Unfortunately, the results, the actual performance of active fund managers has been suboptimal. It hasn't been as good as the market, and many fund managers fail to perform in line or better, in fact in some cases materially worse, than the underlying benchmark or asset that they are trying to beat. Not only that, they also charge you as an investor quite a lot of money for the privilege of you giving them the money so they can actively manage it. So you're getting a double whammy negative. Not only is your performance suboptimal, but also you're paying higher fees.
So it's one of those things. It's like a bookie, I guess. The bookie makes money regardless. I haven't seen too many fund managers that have stepped up and said, tell you what, if I lose money, I'll pay you back.
There aren't many that do that, but there are some that, because a lot of the fund managers work on a performance fee. They work on a percentage of the fund initially. Hedge funds started out, they were 2 and 20, so you'd pay 2% to the hedge fund manager of your funds under management to look after the fund, and if they beat whatever index or whatever benchmark they had, you would pay 20% of the outperformance. So they were the 2 and 20. Over time, due to competition, that 2 and 20 has been eroded to 1 and 15 or 1 and 10. And this has been an active fund manager's bane of their life, is because, as they should be, they're held up by their performance. If you don't perform, you shouldn't be rewarded. Shareholders, the actual fund holders, suffer because their performance is bad, and therefore it should be the fund manager himself should suffer as well when their performance is bad. And that's why it's good to have stocks like, we've talked about Magellan in the past. These guys are good fund managers. They've outperformed, so their fees grow. Not only do their funds under management grow, which gives them a base level of fees, but also gives them that kicker of performance fees. So that's what active managers do.
So that's active. And so juxtaposed to that, what is passive investing? So what, they're sleeping at the wheel?
No, it's not sleeping at the wheel, but it is passive in that it replicates the underlying asset, the underlying basket. So a passive investment might be through an exchange traded fund,
so an ETF. I'm sure listeners have heard before.
So that fund may just invest in the ASX 200, and its performance will track exactly within minute amounts of difference the performance of the ASX 200, for instance. So there will be no over or underperformance of significance. It will do what the ASX 200 does, which is in complete contrast to what many active fund managers do, who can't beat the ASX 200 for all their smarts, for all their strategy, for all their committee meetings and investment meetings. A lot of them fail to beat the ASX 200, and passive investments will match it. Now, the other great draw of passive investments is because they're passive, they don't require a genius to run the thing.
They're just computer generated, aren't they? In the most.
To an extent, well, someone has to program the computer, and I've played that game in a previous life. But yes, in effect, they are pretty much, they track an asset, they do what it says on the tin, and as a result, the fee structure is considerably lower. And if you're talking about when you're looking at performance of your super fund or your investments over time, fees is one of the big issues. If you're being charged a lot in fees, then it will have a much greater detrimental effect on your performance.
We look at active versus passive. It sounds like to me then that passive is a set and forget and virtually risk-free then. If you're just following the index, you're going to make money regardless. Is that true?
No, that's not true, because if the index goes down, you go down. They're not set and forget because there's so many out there that you can swap and you can just use passive investments as part of a big portfolio and swap and change different passive investments to get different exposure to different assets. So you can use passive investing as an asset allocation tool.
But isn't that sort of an active passive investing then? If you're out selecting a range of passive investments, you're actively doing that. Juxtaposed to, I just buy the ASX 200 index. That's it.
You could do that, and you will just get the performance of the ASX 200. But that's not
which has done 19% this year.
Which has done 9% this year, but had a pretty shocking last year. So it's not all beer and skittles. So as an investor, you want to diversify. You may want to diversify passively and say, okay, I want to buy a ETF product that's exposed to global stocks, the global market, and there are ETFs that do that. In fact, there are ETFs that do
virtually anything,
anything you want, and some are leveraged and some are not, and we could explain that in greater detail maybe at a later time. But generally, there are an awful lot of products out there that you can use to diversify, because people don't just want exposure to Australia, they want exposure to America, they want exposure to China, and you at some stage you have to make an asset allocation decision. Even if you're a passive investor, you have to say, okay, my asset allocation is Australia, then fine, buy a ASX 200 ETF. If you say I want exposure to China, Australia and the UK, you can do that as well through a passive investment, and they will track the underlying assets in those indices or baskets and give you that performance gain.
So let's talk then about the risks involved, because when everything's got upside and everyone keeps thinking, they're looking skyward and everything's fine and dandy, but when things go wrong, what does it look like in this sphere of investing? So let's say in this sphere of investing, let's say you are a strong passive investor, you put all your eggs into ETFs, even though you've got a diversified ETF portfolio. What are the dangers of doing that?
I don't know is the answer, because it's never really been tested. The biggest danger out there is that everybody rushes for the exit at the same time. The problem with ETFs is that they haven't actually been stress tested under something like a GFC or a crash environment. And if you're buying into a basket of the underlying asset, that's fine as long as the underlying asset is liquid. Now, if that underlying asset that you've invested in, whether it's, let's just say it's tech stocks in China or whatever, if the liquidity in those tech stocks in China dries up completely,
and that's a possibility, isn't
it? It is, because it's happened before, then the liquidity and the ability to get out of the ETF is pretty much stuffed. So the ASX 200 or the NASDAQ or the S&P 500, we kind of know the liquidity of those indices. But even so, the under stress conditions like the GFC, there may not be a bid for National Bank, Westpac, Commonwealth. There may be, the bid may be $1 below the last trade, maybe $1 below the low of the year, who knows? But the point is that we've never stress tested these products, and they've grown so huge that if everybody rushes for the exit at the same time, we don't know how the systems will hold up. We don't know how, because if you're selling your ETF into the marketplace on the ASX platform, the buyer of that then has to sell a little portion of every underlying asset. Now,
And this is usually computer generated.
it's really
isn't it?
simple. You know, you sell a ASX 200 ETF, however much you sell, and that then generates orders to sell
The underlying
the
assets.
underlying 200 shares in the right proportion that they are weighted in, and it puts that in the market straight away. And every time you buy, it just does it. Buy does it. Buy does it.
So it can
Easy.
have a self-fulfilling kind of prophecy, like a snowball going down a hill. If all of a sudden sentiment is going negative, the ETFs start doing their triggered selling.
Yeah.
All of a sudden it sets off more, and
Yeah.
it has this catapulting, self-sustaining kind of effect.
It does to some extent, but also the other problem is that whether the counterparty that you've invested with, say it's Vanguard or BlackRock or whoever the ETF is through, whether that has the system capability to handle a gazillion orders coming down the pipe all at once to get out before it crashes. And that is another issue. And we see so many times.
And that's the unknown.
Well, that is the unknown. We see many times when ComSec will go down or Westpac trading platform will go down through sheer volume of numbers. And that's not to say that if we had another GFC, if the sheer volume of sellers in the ETF market was such that the platform basically started smoking, and the underlying fund manager who's responsible for that ETF couldn't cope and the servers couldn't cope, you could see a very suboptimal outcome.
Suboptimal outcome. It's a nice way of putting it, Henry. And again, some of the facets here, when we look to the three big risks that again this particular article identifies, first of all is value distortion. So when passive investors rely on active investors to keep the market efficient, because if they're just following the trend, somebody's got to be leading the way sooner or later. Somebody's got to get out there and make a market, right?
It's not so much that. It's more the fact that passive investing is non-discriminatory. You are buying assets at what could be the top of, if you're buying NASDAQ stocks, you're buying NASDAQ at the top, potentially. And that top has been pushed there because people have bought Apple way up or Amazon way up. Now that valuation of Apple and Amazon and therefore NASDAQ could be completely distorted by certain parts of that index. So you can get this distorted amount and huge money chasing these assets for not any discrimination about actually what the underlying company or asset is doing.
So you've got the value distortions. We've talked now about unproven investment strategies. We just don't know what's going to happen if the tsunami happens and everyone's rushing for the exits. And then the last one we've also talked about is rules-based decisions. So when we are looking at what would normally be an active investor's view of the world, you've got a computer sitting there doing decisions that are predetermined, because the ETF has a set of rules that says, if we get a redemption, we need to cash this many shares in at such and such whatever the market value is, and away it goes.
Yeah, I think a lot of the dangers are not so much in the index products like the ASX 200 ETF or a NASDAQ ETF or an S&P 500.
Sure.
Where the dangers are in what they call leveraged or exotic ETFs, where they have some sort of leverage to a market. So if the market goes up by 1%, they go up by 2 or 3%.
Yeah.
Now that is far more dangerous in a meltdown scenario or a melt-up scenario, because we don't really know how that leverage can really distort things.
So in conclusion, ladies and gentlemen, there's a case to be made for both ways of going. And again, I've written on my blogs over the last couple of years a trend for the lazy investor, and ETFs I think is the perfect product for a lazy investor, because it enables you to have the diversity and asset allocation across a range of industries, a range of products, a range of companies or indexes either here or internationally. So the key, though, that I think we'd like you to take as a key takeaway from today's discussion is that whilst passive investing is continuing to grow, and one of the biggest factors I think is cost. It's a cheap way of getting in.
Yeah.
It's not risk-free.
No.
Okay, and I think some of the things that you've discussed, Henry, and again these articles that we can make available to you if you want, just reach out to us on email. I'll certainly make the links available to you. If you have a lot of comfort in an active manager that he or she is representing your interests and investing your money wisely. Well, great, keep doing what you're doing.
Yeah.
Passive investing also has a lot of appeal, and a lot of the people that I meet in SMSFs like to do it yourself. So passive also has a great amount of appeal. But like all investments, nothing is risk-free. So always look under the covers and make sure you know what you're doing.
And I think passive investment is good for people who look at maybe the big picture, look at the big macro picture and go, okay, I like China, I like Japan, I like Europe. And then they don't want to go to the granular level of which companies will do well. So I think that's important as well.
Now, I think you make a great point. So, ladies and gentlemen, that's a wrap for our little education piece this week for Dollars and Making Sense. Again, Henry, thanks so kindly for your contribution.
Pleasure.
That's a wrap for this year. Season's greetings to you all, and all the best.